Welcome back to the Deep Dive. Today we're looking at something pretty fascinating, actually. A huge, almost hidden financial world built on, well, airline miles, coffee points, credit card rewards, all that stuff. And get this, just to kick things off, globally, the value of all those unredeemed loyalty points, it's estimated to be over $500 billion.
$500 billion. I mean, it's staggering when you think about it like that. It's like a shadow currency, really, bigger than the economy of some decent-sized countries. But here's the rub, historically anyway. Every single one of those points on a company's books, that was a liability, a debt they owed to customers down the line.
Right, a big headache on the balance sheet. And that's what we're digging into today. How sophisticated fintech, financial engineering really, is flipping that, turning this giant pool of liability
Even a stable, investable asset.
Yeah. Something banks and investors actually want.
Exactly. And it's not just theory. I mean, look at the loyalty management software market alone. Sources say it's around, $13, $14 billion now?
Yeah.
And forecast to hit maybe $60 billion by 2032. So this isn't just about, getting you to buy another coffee. It's serious finance.
Okay, so where do we start? You mentioned airlines were kind of the blueprint for this. Why look at them first?
Well, because they proved it could be done. They showed that loyalty programs themselves are financeable assets you can borrow against. And the real stress test was 2020, right? Travel just stopped.
Oh, yeah. Disaster for airlines.
A complete disaster. They desperately needed cash. And guess what? Their loyalty programs, those miles programs, were often the only reliable asset they had left to pledge.
And they didn't just dip a toe in. United was a Mileage Plus. They raised $6.8 billion against it.
Huge numbers. And American Airlines, Advantage, they did a record $10 billion bond and loan deal.
Wow, $10 billion.
And those deals, they were oversubscribed. Investors were queuing up.
So why? What made them so attractive when the core airline business was grounded?
Okay, this is the key insight. The cash flow was stable and, crucially, uncorrelated.
Uncorrelated, meaning?
Meaning it wasn't directly tied to whether planes were flying or not. See, for the big airlines, something like 50 to 75% of the revenue their loyalty programs generate, it comes from partners.
Like the co-branded credit cards.
Exactly. People were still using their United or American credit cards at the supermarket, paying their bills, buying stuff online. That spending generates miles, and the banks pay the airline for those miles.
So the money kept flowing into the loyalty program, even if ticket sales had dried up.
Precisely. That uncorrelated cash flow, that's music to an investor's ears, especially those looking for stability. Pension funds, big asset managers, they saw these as safe bets, offering yields, kind of similar to other solid asset-backed securities, maybe in the 4 to 6% range.
Okay, so that established the principle. If it works for airline miles, with predictable behavior around earning and burning.
Then the argument is it can work for, almost any reward program. Coffee points, supermarket points, bank rewards, the fragmented stuff.
Right. So let's get into the mechanics then. Using a platform, say, like Playbasis as an example, how do you actually transform those points, that liability, into something tradable?
Yeah.
Something investors can back?
Okay, mechanism one, it all starts with isolation. You need to ring fence the risk. And that means creating a special purpose vehicle, an SPV.
STV. Okay, I've heard that term. It's like a separate legal box.
Exactly. It's bankruptcy remote. Its only job is to handle the loyalty assets and the related debt. So the SPV goes to, say, a big coffee chain and buys their points in bulk.
Buys the points?
Yeah, buys the liability, essentially, but at a discount. Maybe pays 70, 80, 90 cents for every dollar's worth of points.
Okay. So the coffee chain gets cash up front, gets the liability off its main books.
Correct. And the SPV now holds those points as inventory. It owns the obligation to the customer.
And the lenders, the investors providing the money.
They lend directly to the SPV. Their loan is secured against the SPV's future revenues, primarily the money coming in from partners buying points and the predictable patterns of redemption. It's walled off from the coffee chain's performance.
Okay, that makes sense for risk isolation. But hang on. What if the program gets super popular, like way more popular than expected, and everyone starts redeeming their points at once? Doesn't that blow up the SPV's finances?
That's the core risk, absolutely. And it's managed a couple of ways. First, mechanism two, selling redemption rights.
Redemption rights.
Yeah. So the SPV, having bought points at, say, 80 cents on the dollar, can then sell the right to redeem those points to other partners. Think banks wanting points for credit card promotions.
Okay.
They sell these rights at maybe 85 or 95 cents on the dollar. They get the cash up front from the bank.
So the SPV gets its cash immediately, locking in a profit margin.
Correct. It captures that spread, maybe 10, 15% right away. And crucially, from an accounting perspective, like under IFRS 15 rules, the platform running this only recognizes the revenue when the customer actually redeems. So the big liability isn't sitting on its main balance sheet.
Clever. So that's one layer of financial cushion and profit. What else?
Mechanism 3, breakage. It's a slightly morbid term, but...
The points people just never use.
Exactly.
Yeah.
Industry standard is often around 10, maybe 20% of points issued just expire or get forgotten.
Right.
For the SPV, that's pure profit eventually. The cash was received for points that never get redeemed.
Okay.
And there's more. The cash the SPV holds before points are redeemed, the float isn't just sitting there, it's actively managed.
So they invest it.
Yeah. In very safe, low-risk, short-term stuff. Money market funds, repos, short-term government debt, things that generate a small, predictable yield.
So the unredeemed points basically generate interest income that helps cover the financing cost of the whole structure.
Precisely. It all helps make the structure self-sustaining and profitable.
It really sounds like you're building a structure that appeals to different kinds of investors then.
That's the goal. You've got, say, venture capital funds. They might invest in the tech company itself, the software, the AI platform, hoping for that high-growth equity return.
Right, the sauce model.
Yeah. Plus, they might get a slice of the SPV's profits, like a carry on the securitized debt pieces. Maybe 10% of the upside there.
Okay, and then the other side.
Then you have the more conservative investors, banks, big asset managers, insurance companies. They're not looking for VC-style returns. They want stability.
The bond-like returns.
Exactly. They provide the debt financing to the SPV. They get that steady 4-6% yield backed by those predictable consumer cash flows and cushioned by the breakage and the structure.
Okay, the financial engineering is impressive. But you mentioned millions of transactions, high frequency. This isn't just legal documents. There has to be some serious tech underneath all this.
Right. Oh, absolutely. That's the shift from just financial structuring to true fintech infrastructure. You need technology to manage this at scale. And the core piece of that tech is often an AI-guided decision engine. Some call it the adjudicator.
The adjudicator. Sounds serious.
Well, it kind of is. Think of it like a portfolio manager, but for loyalty points. It uses machine learning to constantly optimize which reward to offer which customer at which moment.
Based on what?
Based on everything. How much funding a particular merchant partner has put in, overall budget caps, the system's risk exposure, the predicted uplifts. Like, how much more likely is this customer to buy something if we offer this reward right now?
So it's making real-time financial decisions about reward issuance, not just marketing decision.
Exactly. It's choosing the best next action financially for the whole system. Less spray and pray marketing, more like high-frequency trading for points.
Okay, that makes sense for optimization. But you mentioned banks, insurers, heavily regulated industries. How do they get comfortable with this? Compliance must be a nightmare.
That's where policy as code comes in. This is critical.
Policy as code. So turning rules into software.
Pretty much. But the key is you start with plain language rules. Stuff compliance officers understand, like customers in California can't earn rewards on alcohol purchases, or no user profile should accumulate more than $100 in rewards value per calendar month.
Okay, simple rules.
Those simple rules are then translated directly into computer code. Code that is version controlled, auditable, and automatically enforced by the platform.
So it removes the human error element.
Yeah.
The platform can't issue a reward that breaks the rule.
Exactly. And every single decision, every point issued or redeemed has an immutable log. You can prove instantly that you were compliant. There's a full audit trail.
That must speed things up massively for banks, instead of months of compliance reviews for a new promotion.
It can be days. Because the rules are embedded in the system, they can innovate much faster, knowing the guardrails are built in and provable.
Okay, AI engine, policy as code. What else? You mentioned a network effect earlier.
Right. The ultimate vision for a platform like this is to become a loyalty clearinghouse.
A clearinghouse?
Yeah.
Like for stocks or payments?
Sort of, yeah. Think about it. If the platform aggregates demand from lots of different banks wanting to issue points and lots of different merchants wanting to accept points, the SPV, which holds all this value and manages the flow, effectively acts as the central counterparty. It settles the transactions between everyone.
So points I earn using my bank, a credit card, could potentially be redeemed instantly at merchant B, even if they weren't direct partners before.
Exactly. The platform, through the SPV, clears and settles that value exchange. Just like Visa or MasterCard, allows you to use your bank's card at millions of unrelated merchants.
That creates a huge network effect. The points become way more useful for me as a consumer.
Massively more useful.
Yeah.
And that utility makes the whole network stickier, more valuable, reinforcing the platform's position.
Okay, so let's try and sum this up. We're talking about a tech company. Yes, selling software, AI tools.
Wait, the sauce component.
But it's also fundamentally a fintech innovator. It's creating a whole new investable asset class out of, well, loyalty points.
Oh.
Using financial plumbing like SPVs and securitization.
Yep, and the initial investors, especially those providing the debt to the SPV, they're essentially providing the fuel, the cash pool needed to buy up those initial point inventories and guarantee liquidity to get the network started.
But the whole thing, the stability, the investor confidence, it really hinges on getting the predictions right, doesn't it?
Absolutely. The entire model rests on accurately predicting and managing that huge liability. You need very precise modeling of redemption rates, how quickly people use points, that breakage percentage we talked about, overall customer spending patterns.
And you need a buffer.
Definitely. You always maintain a safety cushion, typically holding reserves equal to maybe 10 or 20% above the currently projected outstanding liability. That ensures the system stays solvent even if redemption rates tick up unexpectedly. Integrity is everything.
It's really quite a deep dive into how finance is finding new ways to structure, well, almost everything in our daily lives. So here's a final thought for you, the listener. If these complex financial tools, securitization, SPVs, AI optimization, are now becoming essential just to fund the coffee points or air miles you earn, how might that change things for us? Will loyalty points actually become more valuable because they're financially backed like this? Or will the constant need for predictable yield mean our rewards just become more tightly controlled, more mathematically managed, maybe less generous? Something to ponder next time you're checking your points balance.